Welcome to this edition of Diligence Inside Europe's Boardrooms. I'm TK Kerstetter and I'll be your host for today's show. We're going to be talking about proxy advisors, ESG rating agencies, and European companies today. And joining me is somebody that spends a lot of time looking at those issues. Welcome Jonathan Nelson, who's the head of research for CGLytics, and also in his career spent a little time at proxy advisor ISS. So welcome, Jonathan.
Oh, thank you. Thank you, TK.
So I think we better start by, if you don't mind taking just a second or two to explain. I know CGLytics is a diligent company, but if you could explain a little bit about that and then what your role is in the company.
Sure. So I'm the head of research for CGLytics. We are a corporate governance data and analytics provider. That means that we provide the corporate governance data. We collect and provide and standardize corporate governance data for about 5,500 companies around the world, but primarily focused on the US, Canada, and Western Europe. And then we also have a suite of tools that we provide to our clients that can then take that data and manipulate it in a variety of ways that fill their needs. We have the capacity to create a board skills matrix, for example. If you're a member of a board and you want to evaluate where there's potentially a gap, where your business strategy really needs the expertise. We also have a pay-for-performance modeler that has been developed over time, and we actually use in conjunction with one of the major proxy advisors in the world. So more or less, we provide a suite of governance data and analytics to a fairly neutral audience. We don't provide ratings. We don't provide vote recommendations. So we're able to offer this suite of products to both issuers, so corporate boards, executive teams, as well as institutional investors, and then third parties, such as proxy solicitors, compensation and governance advisory firms as well.
Knowing you have a background in proxy advisory, I think might be a good place for us to start again is talk a little bit about the relationship between proxy advisors and European companies.
The proxy advisors are primarily active during proxy season, right? So when companies are having their AGMs. It's a very short condensed period. It's about 3 months. Depending on the market, it ranges from starting February all the way till about mid-May, right? During this time, most investors will actually subscribe to one or two of the major providers, and they'll take their recommendations into consideration when actually making voting recommendations. Most of these proxy advisory firms have their own standard in-house policy per market, right? So there'll be an ISS or Glass Lewis France policy, an ISS or Glass Lewis UK policy. But for most investors are obliged to have their own policy that they apply across the board, right? Sometimes they deviate based on market norms and standards, but then these policies will be applied either through a team that provides these recommendations, customized recommendations in-house at one of the proxy advisory firms, which is then sent to the team inside the major investor, who then focuses on those companies that need more attention, right? The bigger proxy battles, for example, or the higher profile AGMs like Shell, typically the higher profile companies.
Or poor performing companies.
Poorly performing companies, exactly. And then they'll take for the rest of the recommendations, they'll more or less let those pass through, get verified by the team briefly inside, and then they'll be voted automatically. Then there will be a period afterwards where there's an audit, and each of the investors will go through, make sure that their policy was applied appropriately to the companies in their portfolio. If there were exceptions made, right, because European companies, European investors engage significantly more than American investors, or at least that's historically the tendency.
Jonathan, we both know that the proxy advisors can raise the dander on a lot of corporate boards, okay? And there's always these issues of whether mistakes were made or something's happened. So there's always been a contentious relationship between corporate boards and proxy advisors. I know in the States that they're trying to put more regulation on proxy advisors, want to be careful on conflicts. What's happening with European countries in regards to regulation around proxy advisors?
Yeah, there's been, the EU has actually been working on a similar initiative. There's, I believe, a tentative directive to regulate the influence, or to at least moderate the influence of proxy advisors, where they have to disclose in a similar way as in the US who their investment base is, or who their investor clients are, for potential conflicts of interest, right? And that primarily lies in the fact that some of these proxy advisors actually sell the model that they use internally to make their proxy recommendations to issuers themselves, right? So that which is sometimes seen as rigging the system, right? To make sure that you get a yes vote. But historically, Europeans have, like I mentioned before, they've engaged with their companies. They have very close relationships. So it's not been quite as contentious, the EU dialogue with the proxy advisory firms. And it's actually come to much more of a working group best practices standard, as opposed to heavy-handed regulation as you see in the United States.
Yeah. Would you say that the fact that European countries engage more relates at all to when we look at the activist numbers in the US versus UK versus other European countries? That's about the ranking of activity, but is it your view that those engagements have a large?
Oh yes, definitely. I noticed this because I've worked on both sides at one of the major proxy advisors. I worked in the US, and then I worked with the client, with the custom team in the US and in Europe. And the first thing that I noticed was that the European side, the relationship between the team, the ESG or corporate governance team on the inside of the asset manager or asset owner, always had a much more intimate relationship with the management of the companies that they owned. They're also, because they're in the United States, you have the ERISA requirements where you have to actually vote at every single company, right? They're allowed to focus the European investors are allowed to focus their range of vote, or their scope of voting, to a smaller select group of companies, right? So they're allowed to actually concentrate a lot more heavily their attention and their engagement on the companies that are prominent in their portfolio.
Yeah. So taking a step forward, could you share the sort of difference between and identify some of the ESG rating agencies, and then the difference and yet how they relate to the proxy advisors, and how in the European countries that information is sort of being used?
Yeah, absolutely. So you have the major ESG ratings providers, right? You have MSCI, you have CGLytics, you have ISS Ethics now. ISS, which is also a proxy, it's the largest proxy advisor in the world, has acquired through time several different smaller ESG providers because of this, because they have noticed the trend, the long-standing trend in Europe, that the when Europeans, asset managers actually want to implement their voting policies, they'll actually have concrete ESG issues that they want to see the company disclose. And if they do not disclose, they will pick an item, typically an item that is always on the agenda, or they'll have a part of their policy that is specifically set up for, like, always vote against the chairman if X ESG issue is not disclosed in the company's report, or if X, if vote against the company's acceptance of financial accounts if GHG emissions are not disclosed, etc., or if the workplace safety numbers aren't disclosed, or if the company does not have ESG performance criteria in the executive compensation plans. So, and Europeans have long, on the European side, the European investment community have more heavily relied on these rating agencies over time, and the debate has been always a bit more robust in Europe than in the United States. Actually, I believe the first standardized ESG reporting first ESG reporting standards, GRI, within the Global Reporting Initiative, it's actually based here in Amsterdam. Although in the US, SASB is more or less the standard as well, right? So, and it's getting to the point now where actually, like I said, ISS acquired all of these smaller firms because they also realized that the trend is spreading, right? It's spreading very slowly, but it's starting to spread into the US as well. But it has always been more concrete here in Europe. And that's, I believe as well, why the level of activism has always been much lower in Europe than it has in North America. Because Europeans, they have this dialogue, the regular dialogue with the investment companies. They have their means of expressing their dissent, right? So they don't have to actually go through regulatory measures like filing stock or shareholder proposals, et cetera. I believe that this trend is going to start rolling over into the US, although there's a lot of friction against it. And I believe that some of that friction is you'll see implemented in whatever rule is put into place for proxy advisory firms in the United States, was actually implemented. But you're going to see, and you will see more and more cohesion between the two, right? And a lot of the firms, the investment firms in Europe, primarily in Europe, but it's also starting to spread in the United States as well. What they'll do is they'll look at the rating agencies, the ESG rating agencies' evaluation of the company's practices, and they can either decide not to invest in them, right? So you can it's called exclusion.
If
right?
they aren't an index fund. Yeah.
Right. Yeah. It's portfolio exclusion.
Right.
Or they decide, we see these low numbers, we can see maybe there's some value creation potential there, right? So then they'll actually dive in, they'll invest in these companies, they'll try and turn around the E, S, or G factors, typically starting with the G and then rolling around to the E and the S, in order to bring those numbers up and to create value, right, for shareholders, primarily for shareholders, right, which takes a different viewpoint from a fixed income perspective, right, which has a much longer time frame.
Right. So we have about a minute left. So if I asked you to look into your crystal ball and say what's going to happen in sort of proxy voting and votes from institutional investors and whatever looking forward, what would you offer in European countries?
I think you're going to see the further integration of ESG data in the proxy voting decision making to the point where every item, basically you're going to see an integrated report. You'll have a proxy paper or a proxy report issued by one of the major proxy advisory firms, integrated completely with one of the ESG reports on the company in question, so that you can have a full view of the ES and CG practices of the company to make a fully informed decision.
Well, we'll have to see what happens. It's for sure, though, that you can look to Europe and sort of predict what's going to happen in the U.S. in this particular space because, as you said, Europe is sort of ahead in coordinating that much better than the U.S. is right now. So, Jonathan, I want to thank you for taking the time, help us learn a little bit more about proxy advisors and rating agencies. So thanks for taking the time.
No, thank you for having me. It's a pleasure.
And that will conclude this episode of Inside Europe's Boardrooms. We'll be back again soon with another critical topic that'll help you be a better board member or committee member. So we'll see you then.